International sources of authority. The International Accounting Standards Board, IASB, and the broader international regulatory framework play a central role in promoting consistency, transparency, and comparability in global financial reporting. IFRS accounting standards were developed to address the growing need for a unified accounting language that could support international trade, cross-border investment, and multinational business operations. Before IFRS adoption, different countries applied diverse accounting practices, creating confusion for investors and limiting comparability between organizations. IFRS standards reduced these inconsistencies by establishing globally accepted reporting principles. However, the development and implementation of IFRS accounting standards face barriers such as legal differences between countries, varying economic environments, political influence, cultural diversity, and resistance from organizations accustomed to local accounting practices. The IASB operates as an independent standard-setting body responsible for developing and issuing IFRS accounting standards. It functions under the oversight of the IFRS Foundation, which ensures accountability, governance, and transparency in the standard-setting process. The IASB consists of experienced professionals from diverse geographical and professional backgrounds, including accounting, finance, academia, and regulatory sectors. Its primary objective is to develop high-quality, understandable, and enforceable global accounting standards. The standard-setting process follows a structured and transparent approach that includes identifying issues, conducting research, publishing discussion papers and exposure drafts, gathering stakeholder feedback, and issuing final standards. This consultative process ensures that IFRS standards reflect economic realities while addressing the needs of investors, regulators, preparers, and other stakeholders. A fundamental component of the IASB framework is the conceptual framework for financial reporting, which provides the theoretical foundation for preparing and presenting financial statements. The framework establishes the objectives of financial reporting and defines the qualitative characteristics that make financial information useful. These characteristics include relevance, faithful representation, comparability, verifiability, timeliness, and understandability. The framework also guides the recognition, measurement, presentation, and disclosure of financial information when no specific IFRS accounting standard directly applies. By promoting consistency and professional judgment, the conceptual framework helps organizations prepare reliable financial statements that support informed economic decision-making. It also assists standard setters in developing future accounting standards and resolving emerging reporting issues within an evolving global financial environment. The conceptual framework further defines the elements of financial statements and establishes principles for recognizing and reporting them appropriately. Assets are defined as present economic resources controlled by an entity as a result of past events, while liabilities represent present obligations expected to result in future outflows of economic benefits. Equity reflects the residual interest after deducting liabilities from assets. Income and expenses are recognized when increases or decreases in economic benefits occur and can be measured reliably. Understanding these definitions is essential because they influence how transactions are recorded, classified, and disclosed within financial statements. Accurate application of these principles ensures faithful representation of an entity's financial position and performance, supporting transparency, accountability, and comparability across international reporting environments. The IASB framework also emphasizes the importance of professional judgment and ethical responsibility when applying IFRS accounting standards. Financial reporting professionals must evaluate complex transactions carefully and ensure that financial statements reflect economic substance rather than merely legal form. Ethical principles such as integrity, objectivity, professional competence, confidentiality, and professional behavior are critical in maintaining public confidence in financial reporting. The application of professional judgment becomes particularly important in areas involving estimates, fair value measurements, impairment assessments, and revenue recognition. Preparers of financial statements are expected to balance technical compliance with the broader objective of providing useful information to stakeholders. This ethical dimension strengthens the credibility and reliability of IFRS-based financial reporting in increasingly complex international business environments. An increasingly important aspect of the global reporting framework is the establishment of the International Sustainability Standards Board, ISSB. The ISSB was created under the IFRS Foundation to develop globally consistent sustainability disclosure standards that complement traditional financial reporting. Its primary purpose is to improve the quality, consistency, and comparability of sustainability-related financial information provided to investors and stakeholders. The ISSB focuses particularly on climate-related risks, environmental impacts, governance practices, and sustainability opportunities that may influence enterprise value. By integrating sustainability disclosures with financial reporting, the ISSB supports greater transparency regarding long-term organizational resilience and risk management. This development reflects the growing recognition that financial performance and sustainability considerations are closely interconnected within modern corporate reporting practices. Overall, the IASB, IFRS accounting standards, conceptual framework, and ISSB collectively form a comprehensive international regulatory framework that supports high-quality global financial reporting. This framework promotes consistency, comparability, transparency, and accountability across organizations operating in diverse economic and legal environments. Through a structured standard-setting process and clearly defined reporting principles, the IASB enhances investor confidence and facilitates informed decision-making in global capital markets. The integration of sustainability reporting through the ISSB further broadens the scope of corporate transparency and aligns financial reporting with emerging stakeholder expectations. For DIP-IFR candidates, understanding these foundational concepts is essential because they underpin all subsequent technical accounting topics and support effective application of IFRS principles in professional practice.